Hello, welcome to Any Answers Answered for December 2017. As ever, two questions from the Any Answers page that Tim and I are going to work our way through. The first one comes from Anne the accountant. And Anne's question is a very common one. It's actually something we were discussing on Tax TV this month as well. This is to do with 44 years of contribution. The client has just done a pensions check to see what his national insurance record will earn him in his state pension. He was advised he has 39 full years of contributions, which will earn him £137.59 a week, but he has to make another 5 years of contributions before 2027 to get to £159.55. They don't understand. Why? I thought it was 35 years. This person has 44, is being told they need 44 years. The question, effectively, Tim, that Anne is asking is, how could it be 44 or 39 or 35? Explain, please.
Right. It's a little more complicated, as usual, than at first sight. The general presumption is that both men and women have to clock up 35 years of contributions to qualify for the full single-tier state pension, which today is the £159.84 55 pence a week, just under 160 quid a week that's mentioned in the posting. However, that 35-year requirement replaced a lower figure that Gordon Brown introduced of just 30 years, which I always thought was madness because it would reduce significantly the contributions going into the Treasury. But Gordon Brown changed what previously was a system based on gender, under which men had to clock up 44 years, the figure quoted in the posting, women 39 years. So before Gordon Brown, we were looking at 39 years for women, 44 years for men. It could either be primary class 1 contributions above the lower earnings limit, or it could be for the self-employed, payment of class 2, or it could be voluntary contributions under class 3. Those were the three main ways. You could also generate a contribution year by being entitled to child benefit. It's what used to be the HRP, Home Responsibilities Protection. So typically a woman, but not always, who had a career break to bring up the family would get contribution years credited. And the 44/39 requirement, in fact, continues to apply despite the reduction to 30 years and then the increase to 35 years if you were born before the 6th of April 1945. And that's why this particular client of, you told me who it was, an accountant, that's why this client on their personal tax account will have seen that they haven't yet got entitlement to the full pension. And the difference will be that they're, I think, 5 years short, and that'll explain the difference between their stated entitlement of about 137 quid a week and the single-tier state pension of 155.
So the answer is a hugely complicated area, but there are different time scales even today that we need to understand and need to make sure we're advising on when talking to these people. Very, very important thing to consider. And as we mentioned before, something that we discuss in December's Tax TV, if you would like to watch us discuss that in a little more depth. Our second question is a special request that we would cover this, so we are going to cover it. The question comes from the wonderfully named Super Clive 10. I am not aware of anybody called Clive who is super, so the fact there are 10 of them on accountingWEB I find extraordinary. Anyway, the question is to do with a married couple have a mortgage on their home in joint names. They have a property portfolio of 3 buy-to-lets owned jointly. They have 5 that are owned solely in his name. And the question worries me. The question is, we are looking to introduce the mortgage and therefore interest from their home into the lettings business. However, can the mortgage on their home be introduced solely by the husband and the interest offset against his 5 properties, or does it have to be introduced on a 50-50 split? Well, this opens up probably a 3-hour lecture that we could work our way through, so don't panic, we're not going to do that. I'm not really sure where to start, Tim. First of all, can I have mortgage interest on a property business at all these days is probably the first point, to which the answer is yes, though we're not doing it in the old way. But let's cut to the chase. Can somebody just move their home mortgage across to their portfolio and claim tax relief on it?
I'm just glancing down the postings in response to this, and let's not, in fact, cut to the chase. Let's address a question that I think the poster Superclive 10 was particularly interested in, but which none of the posters responded to. And that was the question as to whether a taxpayer who has, in this case, a property letting business in their sole name could be entitled to claim tax relief on interest that is paid in respect of a loan in joint names between, in this case, husband and wife. Now, leaving aside for a moment the issue as to whether the loan interest is allowable at all, and we will get onto that, the revenue should allow that even though the loan, because it's secured on their residence, which is jointly owned, is in their joint names, if the interest is incurred for the purposes of the letting business, and that's what the others address, then the revenue should allow the whole of that interest against the property letting business and not just half of it, but provided that the interest is in fact paid by the husband here. So the loan is in the joint names, presumably because the family home on which it's secured is in their joint names, so the mortgagee would require the loan to be in joint names. But if it is in fact paid by the one that has the business and is claiming tax relief in that business for the interest, then the revenue should allow the whole of the interest, not just half of it.
Okay.
However, let's move on to the point that exercised the posters, and that is whether you can take interest that you're paying on an existing mortgage on your main residence and set that against property letting. And the answer is no, as some of them quite clearly point out in varying degrees of colourful language. However, it is nevertheless possible in some circumstances to obtain tax relief on the interest, but only where you remortgage or take out a first mortgage on, let's say, your main residence in order to finance the property letting business. And the whole point is that property letting businesses qualify for tax relief on expenses in the same way as do other trading businesses. And if the interest was incurred wholly and exclusively for the purpose of the trade, the property letting business, then you can claim relief. But there's a big distinction or difference between an existing mortgage and interest thereon and remortgaging, or maybe drawing on a flexible offset mortgage account and putting that money into the property letting business. And that's where I think the answer to Superclive 10 is a simple no, because the scenario is one where they're not taking out additional funds to finance the property business. They want simply to allocate long-standing mortgage interest on the family home against the property business, and that won't work. But
as you say, if it was a situation where that mortgage perhaps was coming to an end, they were looking for a new mortgage, if part of the plan with that money was to be able to refinance their buy-to-let portfolio, then there's nothing to stop you having interest relief that is secured in a different place against the business.
Yeah, I mean, let me give it an example with an accounting slant on it. Suppose that several years ago, the taxpayer bought a buy-to-let property for £500,000 and they paid cash for that somehow. And we draw up a little balance sheet, debit the property account, 500,000, credit proprietor's capital account, 500,000. Then several years later, they decide to raise a mortgage that they've not previously had on their family home and raise a mortgage of, let's say, 400,000 and take the opportunity to withdraw 400,000 capital from the property letting business. So in double entry terms, we will then be crediting a loan account in that property balance sheet, debiting proprietor's capital account, and that for the interest on that 400,000, which is secured on the family home, is then tax deductible against the property letting income. One important point, though, is that if the buy-to-let property has risen in value from, say, £500,000 to 700,000, and the mortgage that you take out is, let's say, 600,000, the finance costs that are allowable will be restricted to the value to loan ratio by taking the original cost or value when first let of 500,000 over the 700,000 current loans that you've introduced. Did I say 7, or that was the value, the 600,000 loan, and you'd only get relief on that proportion. And that has long been the case, and that's before the 2017-18 restriction to finance costs, which is a different story altogether, with gradually the finance costs being removed from the taxable profit calculation and given only at basic rate.
Okay, and I think one of the problems in this area is that there are a huge number of people, estate agents, some advisors, some banks, all sorts of people offering advice in this area.
And even charlatans, and it is extraordinary the number of times I've had delegates recently say to me, isn't it possible to get around the finance cost restriction by having some sort of hybrid structure with... And
yeah, absolutely.
You're
not.
right.
Be very careful who you listen to. Hopefully listening to us will be okay. Hopefully you enjoyed this episode of Any Answers Answered. We'll be back next month to answer some more questions. Until then, enjoy your tax return season, and we look forward to speaking to you in the new year.